All right. We're live. We got James A. Full Capital. We got Jeremy Roll here. Jeremy, last time I saw you, we were in Salt Lake City. We weren't skiing, but we were just hanging out at the conference. And I am still getting benefit of going to that conference. So thank you for dragging me out there. I mean, just somebody yesterday, I think, emailed me and was like, "Yeah, I heard you on Kathy's podcast," and one thing led to another, and so when we were sitting there, it seemed like everyone knew you already. Some people knew me, but just thanks for bringing me out to Salt Lake and hanging out and putting that conference on.
Absolutely, yeah, and that's what it's all about. So I'm really glad it's helping you. Hopefully, it's helpful for everybody attended too.
Yeah. So today, what I want to do, Jeremy has invested in a lot of deals, a lot of different property types, a lot of different areas. And so what we're going to do is sort of touch on the macro piece of the equation. And then I put together like 4 or 5 deals, and I'm just going to get your take on it because I think that's just as good, or if not better, because I think one of the things you told me when I was first starting investing as a passive was you just need like deal exposure, right? You have to look at more deals, but to get better, right? Because if all you see is one deal a year, then that deal looks great because you have nothing to compare it to. So so let's hop in here. I'm gonna pull up. Let's see. Let me pull up the screen here. Hopefully this works.
I call it opportunity exposure.
All right, you said it a lot better than me.
Same thing.
So here's sort of so I'm going to start with the macro. We're going to go into some deals, and then we'll go into best practices. So
and I just can I just stress to it, because we've done this before. Yeah. I have not seen any of this, so it's very difficult to do on the fly. Not that I want slides in advance, but the deal analysis, literally on the spot, have never looked at it before. So just bear with me, everybody out there, because and also James is much more knowledgeable than me on a lot of topics as well, like lending and everything else. So hopefully between the two of us, we'll piece it together.
Yeah, and I mean, to me, it's not like the deal's important, but then I feel like just the questions that you ask will help people get a feel for what questions they should be asking. So,
got it.
But let's start sort of macro on this piece of it. And I saw this chart. I don't know if it was New York Times or what it was, but I thought it was a good chart to just sort of show like not as many banks have failed, but the size of the banks that have failed just because of interest rates, because of those run on deposits. And when you look at this chart, or just what are you feeling right now?
So great question. So what's really fascinating is the total dollar amount that's already failed has been very significant, right? And also, if you add up the bars on the left, from what I've read, I believe it's over 1,200 banks failed in the last downturn. Okay. But also, if you add shadow banks, which are basically funds that have lent money, hard money, everything else, it's over 2,000. And so take a look at the bar on the right. In 1 year, the 3 banks, huge numbers, right? So that's number one that's really interesting. But what's also interesting to consider is, do you think it's realistic to assume as an investor that we'll have 3 total failures when we had over 1,200 in the last downturn? I think the answer is probably no. I always like going with probabilities, right? So it's certainly possible, but it's improbable. And so I am expecting hundreds of bank failures, which may not happen, if the Fed takes certain actions, whatever, but that's what I'm kind of expecting to be conservative. So when I look at the left and I look at the right, I think I feel like we're in the first inning, or the first half of the first inning, or maybe even the first pitch of the game.
So you're trying to scare everybody now.
I'm just using data, right? I'm just trying to. What I do as an investor is I try to extrapolate history to help project the future to reduce probabilities of failures on my. That's what I do, right. And so the Fed can take FDIC. The Fed can do all kinds of things they've never done before, and there's no more bank failures. Okay, I'm going to be clear. But from a probability perspective, if you want to be smart as an investor, you got to go with probabilities. Are you going to take the 1% or the 99% probability, right? So that's all I'm doing here, reading this chart. And that's what I've been doing in my mind, reading all this information of all these articles. So I'm not trying to scare anybody. I'm just trying to do like an objective analysis.
Okay, so this reminds me of, and this is why I do it to you. The hardest interviews that I ever went through as coming out of college were with management consultants, and all they did was put a chart in front of you, and they didn't say anything. All they said was, "Here's the chart. Tell us what you think."
Yes.
And at the end of 45 minutes, I had no idea if I did good or bad. but all I knew was I was nervous the whole 45 minutes. So,
And this is, don't worry, this is not a job interview. I've had
this is not a job interview. But because when I look at charts, I have an idea of sort of what I'm thinking. So, all right. So you're thinking this is the first inning, and okay, so what impact? Because to me, it always comes back to, all right, what impact does it have to me as an investor?
Yeah.
So if more banks fail, what happens?
Yeah. So if more banks fail, we see significantly more concern on the stock market, significantly less lending, right? Available, but not just for real estate, across the entire economy in all aspects. Credit lines, cars, credit lines are already starting to get cut and reduced right now. The credit crunch has officially started to happen based off the SLOOS report that the government had last week. And we're also, that has a delayed impact, just like rate hikes have a delayed impact. And so I think that, first domino has, so what we're seeing in this chart is like, imagine first domino falls. You push the first domino, but press pause. And that's what we're looking at. The problem is that there's like 100 dominoes that are going to fall. And so one of the effects it's going to have for sure is you're going to have lower loan to values, possibly higher interest rates, possibly higher spreads as a result, with breeding higher interest rates, and a whole host of other things. Of course, this is just probability wise. This is not, it's not impossible that nothing happens, right? But that's my take on it at the moment. And that's what I would expect, just try to be like an objective person.
All right. That's perfect. That's chart one. All right, chart two. All right, so here's the forward curve. This is, I think I pulled it in last week, but essentially the same. 5%, 525. I don't know. Hopefully you can see that.
Yeah,
it's basically just like the market is saying the Fed's going to cut this year.
Yep.
And Jay Powell gets on. He's like, we're not cutting.
Yep.
So the market's saying one thing, Jay Powell saying another thing. What are your thoughts on just sort of going forward curve on interest rates?
Great question. I'm sure most people on here, if not everybody, is very concerned and trying to figure this out. So I have very mixed feelings about this, because if you just read the testimony of Jay Powell word for word and never ever read a news story or media story about this, your impression, like literally, and you didn't ever look at the SOFR curve, your opinion would be that there won't be any cuts this year, right? It's really that simple. If you go back and take the time to read his word for word, you would think there won't be cuts this year. And yet very smart people who are, making bets and creating this curve are saying that's not true. And so it's really tough to read right now. I don't know what to say, because to be honest with you, like, I don't know about you, James, but like when I look at this chart, there are smarter people than me that have actually figured this out, that have actually come to this conclusion, right? And so I don't know whether to go with Powell or whether to go with this. I do know one thing. If you just take a look at history and look at what happens when we have inflation over 5%, you don't just nicely come back down like this chart back to 2% range. It doesn't happen. It doesn't happen in the past. And so if you want to look at probabilities again, you would expect inflation to get stuck between 4 and 5%, which is right about where we are right now. But it just we don't know yet, because we're just getting to that range. And if it gets stuck, the question is, what will Powell do? And that is very subjective, and that's his decision. We have no idea, right? But I will tell you that if you're guiding with that, then I don't know if I agree with this forward curve, if he's really going to just focus on inflation. But it's a very, as you know, it's a very difficult equation. There's multiple factors: unemployment, there's economy weakening, there's a stock market, all this other stuff he has to take into account. So I apologize. I don't have a good answer for this, because half of me says, pay attention to what Powell's saying. He's the guy who's making the decision. Half of me says, people who are much smarter than me have created this curve, and the curve is saying he's going to go down. And it's like, don't, you know how the old "don't fight the Fed"? You
Yeah.
almost like don't want to fight the curve either because they're very smart. So I don't have a good answer for you.
So maybe you can explain this. I've heard that going back to the inflation. So when you go inflation at 9% and you get it down to 5,
Yep.
but then going from 5 to 2, why is that harder? Do you
Yeah.
know? I
So
don't. Yeah.
yeah. So well, the why is harder to explain because I think each scenario is different. But what will tell you what happens normally is that you get to 4 to 5 and you actually have a double dip. You actually go back up a little and then you finally come down. Okay. No one in the media is talking about that at the moment, but if you go look at the charts, that's actually what happens normally. And so I am still going with that possibility, with the exception of the fact that because there was so much money printed this time, they may take the exact opposite approach of creating such a credit crunch that we won't get the double dip. So it's because we weren't dealing with the exact same scenario in the past, right? So I don't want to say it's different this time, but it's possible that it may have a different impact if they're going to let the credit crunch at all these banks fail and the economy get much worse than everybody thinks, right? So it's hard to predict. If you want to go with probabilities, we expect a double dip where inflation will come back up maybe to 5 to 6, maybe even go sideways for a little bit and then go back down. If that happens, would you expect Powell to cut? Definitely not, right? Could he go sideways and pause? Yes. So this is a very tough thing to project. And I got to tell you, like as an investor, so I know everybody on this call or listening to this is on a different position in terms of how it impacts them. For me as a passive investor, what that tells me is that there's potential volatility and unknowns, higher risk, and therefore get on the sidelines or at least protect myself some way if I'm going to invest in something.
So do you take a fixed rate deal or floating rate deal right now?
Oh, I mean, so just to be clear, I never invested in not one of the multifamily floating rate deals, even though it was literally over 90% of what I received as an investor across all asset classes in the last 2-3 years. That's almost everything there was. Right. I am, everybody, there's 1,000 ways to invest. None of them are wrong. I'm a very low risk guy. I can't remember the last time I went into a floating rate deal, like purposefully or anything. So, it's just, I normally try to lock in a 10-year fixed rate loan. And it's very convenient for me to say that today. But if you would ask me the same thing in 2020, I'd tell you the same thing in 2020. So it's just my personality, right? So,
well, actually, 2020 was actually the perfect time to lock every deal because 10-year treasury fell through the floor in 2020.
You could choose any year you want, literally. My point was it's very convenient for me to say that now. But if you actually look at what I do, that's all I've done the whole time. So, and I would also say that one thing that is very important to understand, and I think a lot of investors lose sight of this, doing a value add deal is least risky at the beginning of a cycle and most risky at the end of a cycle. But sponsors will have the highest percentage of deals being value add at the end of a cycle and not at the beginning of a cycle. And I can explain that further, but you're literally being marketed to with the exact wrong type of deal at the wrong time. For a very specific reason. And we can get into that if you want. I don't want to side rail us, but that's very important to keep in mind right now.
Give me the why.
The why is because prices cap rates get so crunched as we go down into the end of a cycle that the only deal that will pencil for a sponsor to actually put together and have an IRR that's attractive is a value add deal. And then you hit 2020 and then cap rates are really down. And now they're having to go to floating rate loans to juice out a little bit more returns to make it attractive for investors. But it's exactly at the wrong time at the end of a cycle. So it's all about, like, at the beginning of a cycle when prices reset, you could buy a nice stabilized deal and attract a lot of investors with cash flow, right? So, but the funny thing is, if you do a value add deal at the beginning of a cycle, you have the most runway left. You got rents going up, you got the economy growing, you got the wind at your back. You're at the beginning of a runway, right? You got all the runway to course correct before you take off. If you do value add at the end of a cycle, you have a very short runway and one little wrong problem and you're done. And that's unfortunately what we're witnessing in real time right now. But it's important for investors to invest with the cycle and understand the risks at the right time, even though sponsors are maybe presenting you with the wrong type of business plan, depending on the timing.
I probably have to re-listen to that at a later date to understand.
I hope it makes sense. I mean,
no, it definitely makes sense. I guess the question is, where are we in the cycle right now?
Oh, we're right at the end of the runway, right? We're at the end of the runway. The runway is 1 foot long. It's done, and now we're resetting to where, like, you're basically going to start a new runway soon. But we're not there yet, right? And we're not there yet because we haven't seen the credit crunch occur yet fully. We haven't seen a recession, which is high probability right now. We haven't seen the impact of that. We haven't seen NOIs go down because of a recession yet. Rents go down because of a recession yet. We haven't seen unemployment go up because of a recession yet. So there is no way I feel like I'm at the beginning of the runway getting onto a fresh runway yet. We're not there yet.
Even though prices have reset 20%.
Well, 100%, because, and I know you really understand this well. If I'm investing in a building today, let's put the cap rate aside. Let's assume the cap rate's the same today as it is at the beginning of year, end of year, same cap rate. What happens when rents go down during a recession and also we're in an inflationary period and expenses go up? What happens is the building is actually worth less at the beginning of the year than at the end of the year than the beginning of the year, all things being equal. That hasn't actually happened yet, and could very high probability could happen. So we haven't reset a new runway yet.
So you're saying the beginning of the runway is when basically NOIs have bottomed.
Yes.
Okay. NOIs at bottom, and that's the beginning of the runway. I got you.
Yeah, NOIs at bottom, but more importantly, I would say that we felt the full burden of a recession. We've had increased unemployment, unfortunately. We felt the full burden of rents going down, which is very key. And now, the economy's starting to recuperate, and now you got some wind starting up at your back. Everything else is a headwind before that, right?
Okay. So can I give a soft plug? I did not tell Jeremy to use airplane analogy runway, but that is our conference this year. So if you haven't if you haven't gone to oldcapitalconference.com, we are having it at the Frontier Flight Museum, and you can go there. And so it was funny because the guy who do you know Keith Cunningham? Keith Cunningham. He was supposedly like the rich dad, the real rich dad.
Oh, interesting.
In Kiyosaki's book. Okay, yep. So and I guess I don't know if he's a pilot or whatever, but he was like, takeoffs are optional, landings are mandatory. So
okay.
So think about the deal. So because if you're a general partner, there's 20 deals on the market. You get to choose if you're going to take on that deal.
Right.
But as soon as you raise the money, as soon as you close, now you're in the air.
Yep.
You've got to land this plane.
Yep.
And if you don't have as much runway, right? You're saying late in the cycle, you don't have as much runway, it's going to be hard to land the plane.
Well, no, but that's actually interesting. I never thought of it that way because I've been using this analogy for years. And the way I think of it is, imagine, you're getting into a deal and the whole business plan is about taking off. Right. And so when you have the shortest amount of runway, you basically will never be able to take off and you're going to crash. And that's what's happening, unfortunately.
Oh, you're not even taking off. All right. I got you. In your analogy, you're not even taking off.
My whole analogy is before you even get in the air. I'm sorry. And now we've confused everybody. So sorry to everybody out there.
No worries. This was a couple of days ago. I have not checked 10-year treasury. I think it is down maybe 20. Yeah. So it's like 335, 340.
Yeah. I got at 337 this morning. Yeah.
But just in general, for people who are doing fixed rate, they more look at 10-year treasury. And this is pretty much what everything is based off of on, Fannie and Freddie fixed rate debt. Mm-hmm. And it has sort of hovered around 3.30 to 4%. What are your thoughts on 10-year treasury right now? Is this the time to just lock in a rate right now?
Yeah, great question. So, I am not by any means a U.S. Treasury expert, especially in forecasting. I see two different potential push and pull factors on the Treasury going forward. One is, and this is just never read this before, I'm assuming this will happen, which is if we have a lot of bank failures and those banks have to actually sell assets to avoid failing or try to do their best to avoid failing, what are they selling? They're selling treasuries. They're selling other short-term instruments that they own that are supposed to be safe. What happens when you sell a treasury? There's more supply and therefore rates go up, right? And so the issue there is essentially we may have a lot of banks selling a lot of treasuries in the coming months to avoid failing, and that could increase rates, right? At the same time, what happens during a recession? Everyone gets scared. People tend to pile into fixed income, and when you have more demand for treasuries, rates go down. So I am not researched enough to be able to tell you where that's going to land, but those are the two things I'm going to be watching. But generally speaking, I think everybody would probably agree philosophically, if you expect the Fed to cut rates over time, you would expect the 10-year Treasury to go down, right? But in the interim, before all that happens, it's I think both of those other factors could come into play. We're going to have to watch in the coming months.
All right, I'm going to add this. So on your first point, the Fed. So you're saying banks can sell the Treasury because they need the money.
Yes.
Right. Okay. So, and I'm not sure if you're aware of this, but the Fed basically opened up the discount window.
Right, but you know how much they're charging for that? They're charging more than the bank is making. Like that is actually a net negative for a bank, right? So
it's too expensive. The money's too expensive.
It's too expensive. So
okay.
Yes, so that's kind of like desperation step one is you borrow a little money off the Fed temporarily, right? Desperation step two is holy crap, we need to start selling all these assets. Our deposits are fleeing. We have to sell to actually build more money because we can't afford the rate at which the Fed is charging us, right? So it's going to be a combination of the two most likely. But then again, I'm not an expert in all this, honestly.
Okay, so you're thinking directionally, if there is a recession, rates come down, 10-year Treasury should come down at some point.
Yes.
Okay. All right. So this is. So you were the first person who told me when cap rates go from 3 to 4, it is a lot more penalizing than when it goes from 7 to 8.
Yes.
And I think people are realizing that now because so this is from CBRE. They had no cap rate data sort of during COVID. I guess there wasn't enough transactions, but essentially this is showing where cap rates are today on Class A deals.
Okay.
And so I guess it's the going in cap versus the exit cap and where it is today. So, let's say it's 325 sort of 2021 and now it is 475.
Okay. That's a huge change. Wow.
And this is on Class A stuff.
Yeah.
Okay.
So I haven't done the math, but have you done the math to see what percentage change in value that creates and wipes out all the typical equity?
We can do it, but it's at least 25%, if not more.
I figured. I actually thought it'd be more. So I'm thinking it might wipe out 35% plus of equity, but I haven't done the math. I could be wrong. Like, in other words, not 35% plus. But if the stack is like 65% LTV and you got 35% equity going into the deal, it might wipe out all the equity.
Yeah. So I did the math for a LinkedIn post. So if you do $1 million NOI and then 3.25, that's about 30.7 is your value. And then you do $1 million at, let's say, 475. So you're basically increasing it by, 1.5. So yeah. So cap's going up. So you're basically going from 30.7 to 21 million.
There you go. So that's what I was just saying. You're at about you lost about 33%, 31% of your equity. That's what I was just saying. You literally wiped out almost pretty much. And frankly, if someone was being really aggressive at 175% LTV, you just wiped out all your equity plus. You're actually underwater.
So when I posted this up on LinkedIn, what people were telling me was, but my NOI went up between 2021 to 2000 blah 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 today. So my question was, did it go up? So it still would have to go up. Let's see, 30.7 times. I'd have to do the math, but it would have to go up a lot.
Yep.
To offset that.
But there's a bigger problem. Okay. The bigger problem is ask them in a year what their NOI is.
Right. So it's gone up for a little bit.
Yeah. Because in my opinion, we are probably going to end up just probability wise with stagflation in the economy. And that is by definition, your rents are going down, your expenses are going up. And so that's going to eat into your NOI. So you're going to have to check back with them in a year and see what the situation is then. And also, if we do have a major credit crunch, I fully expect cap rates to continue to go up. Why wouldn't they? If you can only get a 50% loan to value loan and you want to get a certain return for an investor for risk premium for actually putting your money into work, but you can only get 50% LTV, you're going to have to pay less of a multiple. That's what I would expect a disciplined investor to do. And that's what I'm expecting the market to do.
So what we are seeing right now is stuff is still trading on a 5 cap
Hmm.
right now. And it has not pushed to a 6 or 6.25 or 6.5 to have a big enough spread. And people are still buying these deals.
So you're saying people are still doing negative leverage deals, right?
Yes.
Yeah. See, to me, that no offense to anyone who's done one of those deals who's linked it, but that's just crazy. Like I've always said that was crazy. If you're trying to be a really conservative investor, if you're making the argument there's going to be a ton of value out in the deal, then it's a different discussion and may or may not make sense. But just know that if you're making that argument, you're literally making that argument in the face of a likely recession, which is
Right.
a very difficult argument to actually make. So it's all about risk reward. There could be some deals that make sense, but it's a tough argument to make right now, I think.
Okay. So this is a chart that is a combination chart. And I don't know if you saw this chart when I posted it up.
Yeah, I saw it. I follow you, man. I follow you. I watch your videos. I'm serious. For those of you who don't watch James' videos and stuff, I know you're on this one. They're just so good. I've been watching him for years. He is just so, he did not ask me to say this. He just unbelievable amount of knowledge. Really appreciate everything you do you post a lot on LinkedIn. Great like really appreciate everything you do for the community. Seriously, you're really, really helpful.
So I don't know if I've shown you this risk return chart, and somebody clipped this out of my LinkedIn post and thought Howard Marks did this post. And I'm like,
Okay.
no. Howard Marks does not give a rip about Fannie and Freddie. I mean, maybe he cares about commercial real estate debt, but I don't think he cares that much to put in his book. But all right, so when you look at this, tell me your thoughts, and am I missing something here?
Okay, it's funny because I've seen it, but I never actually thought much about this chart. So you're saying fixed rate agency is the lowest risk and the lowest return, right? Then Fannie Freddie floating is the next. Non-recourse bridge is the next, and non-recourse bridge, no interest. I mean, recourse bridge deserves a spot there too, right? Maybe at the top.
So this is the main thought that he was coming up with. Was a lot of times when we look at a deal, we see let's say a 12% IRR or 13% IRR. We only are given 1 point. And the point that Howard Marks is making in this is that it's really a range of returns. So when you do a Fannie Freddie fixed rate deal that you're comfortable with, you might get a 15 or you might get a 10.
Mm-hmm.
But as you go out further in the curve and you see an 18% IRR, that 18 might become a 30 or it might become a 0.
I see what you're saying with that's the variance bands you have, but they're flipped upside down. Yeah, it makes sense.
Yeah,
Or they're
so
flipped sideways.
so
Yeah,
that's the way of thinking about it in his mind. But
yep,
then I didn't really, so he was just saying that in general.
yep.
But then I dropped on the loan types that are gonna, to me, add more risk to deals because of their structure.
Yeah. But let me tell you an interesting thing that comes to my mind, which you probably wasn't coming to your mind in looking at this, which is there's another piece to this
Okay.
in terms of the returns. It on this exact chart, it makes perfect sense. But what my point about thinking about cycles before totally feeds into this, because there are times at which the Fannie and Freddie fixed rate loan is possibly a higher return than all the way on the right side at the right timing, right? Meaning that not necessarily at the exact same timing, but my point is that in 2013, if you did that Fannie Freddie fixed rate loan, or 2010, 11 on that apartment, and you hold it for whatever amount of time, even a 5-year fixed rate loan, you might have a better return because you got the longer runway, your wind at your back, and everything, versus doing the bridge at 2021, right? And that's not the point of this chart. So I don't want to mess up with the point of this chart, but it's also interesting to consider because I'm looking at the return going up, but you can actually adjust for the return depending on your timing. And that's
so you're adding the cycle timing piece of this
yeah, it would
into
almost be
this.
like
Yeah.
three-dimensional or
Okay.
whatever. But I'm mentioning it again because if there's anything I can impart on people today, It's that just because sponsors are doing a certain type of business plan at a certain time, it doesn't mean it makes sense from risk reward perspective. And that's where this whole runway and cycle timing comes into play.
Okay. Um, we're just going to answer this question real quick. This guy had a question around what's the difference between Fannie and Freddie floater versus non-recourse bridge. So both of them are floating rate, but then the non-recourse bridge is typically a shorter term and typically higher leverage. So a non-recourse bridge, you could get 70 to 80% leverage, and it's usually a 3-year term with sort of a hard maturity. You might have some extensions. And then on the floater, Fannie and Freddie floater, that's a 10-year loan. And it's usually based on a 125 cover on in-place income. So usually your leverage is like 50 to 60%. So I just want to answer that real quick.
And also,
yeah.
before you switch to the next slide, can I just add something?
Yeah.
I think that these bands that James presented here are very important to consider, because I think one of the challenges, and me speaking to a lot of investors who invested in these floating rate deals in the last couple of years with the non-recourse bridge or recourse bridge in some case, is that I don't think investors understood that the band was so wide, right?
Yeah.
I think that they looked at, in most cases, in some cases, clearly that's not true. But in a lot of cases, they looked at a deal and said, oh, it's apartments. It's not very risky. People need a place to live, right? Rents are going up a lot. And they probably thought that band was something more like the Fannie Freddie floating rate band, as opposed to the band all the way on the right. And therein lies a bit of a challenge, I think.
Agreed. Agreed.
Yeah.
Agreed. So, all right. So I we'll get into this a little bit later, but I think if somebody is coming in new and I just give them this one chart and explain this chart to them based on our conversation, they're done. That's all they need to know. Just that one chart. All right. So that's what was going on in my head in terms of the macro side of the equation. But is there anything else investors should be looking at right now that we did not talk about on the macro side before we get into deals?
No, I would just stress that it is very clear what the data, a credit crunch has started. The data actually shows objectively it's already started. The banks have already pulled back. This isn't just like an opinion, it's a fact in the numbers. And we also know that it's the first inning of that credit crunch. And so unless something changes in the market, an investor should anticipate very difficult credit environment going forward for the next at least 6 to 12 months. And there's a very high probability of a recession based on inverted yield curves and other data that we've seen and leading indicators. And so investors should anticipate a very high probability of a recession. And when you combine those two together, unfortunately, you get a lot of carnage, right? And a very difficult time for real estate. And so if you're considering investing in something today, not a problem. There's a lot of interesting deals out there that make sense today, as long as you anticipate what is likely probably going to come up. And I think that that's very, I just can't stress that enough right now, given the current timing that we're doing this.
Okay, perfect. All right. All right. So we're going to jump into deals. So these are deals that I sort of just clipped out some of the highlights, and I tried to pull just sort of what different deals in, so I could just get your opinion on deals that are out there in the market. So let's just jump in here. Okay. So I've tried to hide as much as possible, and hopefully you can read it, and I can make anything bigger if you need to. But I'll give you a minute, take a look at the slide. But basically, this shows a new development deal, and sort of they're all in at about $245 a door. This particular deal was in Florida, I believe. And let's see, basically it's a 0, 0, and then you sell the property.
Yep.
So
yep, which is very typical. So I'm going to be first person to tell you, look, I've never invested in a development deal. I've been investing in real estate 22, 23 years. This is not my forte. I will tell you that there's two things going through my mind on development right now at this timing. First is land pricing is very, very volatile. So as we saw in the last downturn, I mean, it could get cut to 10 cents on a dollar in some cases, okay? Just depending on where it is and what it is, right? Obviously, in many cases, that doesn't happen. But my point is land pricing is very volatile when it's just sitting as land. right, and not being used for something. So first thing is I'd pay a lot of attention to what the basis is going in and whether or not that's a risk, or maybe getting it at the wrong time as far as what the risk is there. Number two, saw a lot of this happen in the last downturn, which is there are contracts from banks to provide lending at certain intervals based on certain milestones in development. They're typically handed in tranches. And again, I'm not an expert, so James, if anything I say is wrong, feel free to correct me. But what we saw last time, I mean, there was a building that was about a 100-unit apartment building that was being built literally walking distance where I used to live during the last downturn. And I watched it go up, and then it just sat there. And literally the only thing missing was the landscaping. And I'm waiting and waiting, because literally I was waiting to see what it was like possibly to even go in there and rent a unit.
Yeah.
And just for myself. And it eventually, a year later, got foreclosed. Someone else bought it 2-3 years later, finally finished. And what happened? Because I asked, they couldn't get the last 10% tranche to complete the landscaping and other last minute things. And they ended up foreclosed not because they weren't owed it by the bank, because the bank just didn't hold up their end of the bargain, because you can't extract money from a bank if they're not sending it to you, right? It's an obligation in a contract, but you can't force them to send it to you. And so I would be very careful with development right now and to understand where the capital is coming from, how guaranteed it really is. Is it an escrow sitting for you there based on milestones that an escrow agent is actually like checking the box and sending it to you? Or is it based on some IOU that a bank is supposed to be sending you in the future? That's my main concern for doing development right now, is you actually going to get those tranches. We could talk about rents adjusting, pro formas, all kinds of other stuff. And are those realistic rents, and what are the real returns going to be? Just consider some of that. But again, I am not by any means a development expert at all.
So I usually do not follow land, but what I have seen are a lot of land listings where people basically are saying, it's ready to go. Come develop this piece of land. It's already entitled, blah, blah, blah. But that guy who owns it, they don't want to do it. They want to sell it to somebody else to do it. So I'm seeing a lot more of that. And what was happening, let's say 12 months ago or even 18 months ago was, all right, well, I've got, one building done, or I'm, 5% occupied. I'm 10% leased. Do you want to buy it for the full price now? Sure, I'll buy it now. Full price. Right. Like it's not even leased up, but people are buying it. Right. So people are just getting out of deals a lot earlier than they were. The one thing that does seem interesting from the development side, and what people are saying is, because it is going to be so hard to get financing for development, that when I deliver 2 years from now, there's going to be no competition. So if I can get through this process and get the thing delivered, I'm going to be the only Class A deal in town is the pitch.
That could be the case. The only thing I would be very careful with is understanding the projected rents at that point, given that we may go through a recession, increase in unemployment, et cetera, and making sure that those projections aren't overstated. But I do want to say, the one thing I was going to say, James, is that my speculation as to why you're seeing a lot of listings is because, these land deals are done in different phases. So you have to get it entitled, and then it's very often you get it entitled. That's your forte. That's your business, and just sell it off to a developer because you don't do any of that. Right. And that isn't necessarily a red flag. The red flag is all the supply of people trying to dump this land now, because I think they realize with the credit crunch, if they can't find people to buy it to actually execute on a development because there's no capital and liquidity to be able to do that, their entitlement deal is going to sit there literally for probably years until they can find someone to do it again. So I think they're literally realizing they're in the 9th and a half inning of being able to flip their land, and they better get out right now, because of the credit crunch. That's just speculation on my part.
Agreed on that. And then to me, if you were to take on a development deal, what return would you expect?
Great question. First of all, I would not take on a development deal unless we were at the beginning of a cycle. Okay. Unless we're at the beginning of a cycle. Okay. Or very early in a cycle. And that's so, again, I have as much runway as possible to take that plane off, to finish that deal, and to have the headwinds at my back with rents going up, et cetera. So I wouldn't be doing one right now when we're about to face a recession with rents potentially going down and unemployment going up. If I were to do one, So what was very common and what I saw in the last cycle, at the beginning of the cycle when I saw some development deals was, you may have like a projected IRR of 15 to 18% on a typical deal when cap rates are much higher, interest rates were higher. But then you may have a projected IRR in the 30% range, give or take, could have been 32, could have been 25 to 30, 27 to 32 is the most common thing I saw. So if you take a look at that spread back then, when there wasn't that much capital sloshing around, beginning of cycle, et cetera, then you're looking at, a 1.75 to 2x premium in the projected IRR compared to a stabilized deal, or like, even a minor value add deal that wasn't so risky. So that's what kind of formula I look at if you were forcing me to do it, but it's not something I've ever done. I'm just kind of thinking it through.
So the value add deals at 15 to 20, and then the development would have to be at a 30 IRR.
Yeah,
essentially.
Yeah. And I think the problem is that if you look at developments and towards the end of the cycle, you weren't seeing IRRs at that price. And again, you're end of cycle, you have the most risk, and yet the most amount of money sloshing around trying to allocate, and you're not getting the return for the risk. You're not getting compensated for the right risk. And just like there's negative leverage deals right now, you're not getting compensated for the level of risk at the moment.
Got it. All right. All right. This is the next one. So this is a normal. I'll just walk you through it a little bit. This is a normal value add deal.
Yeah.
25 million, and they are putting in. So they're buying for 25 million. They're putting in about 5 million, and then they are doing a bridge loan at 17.7, and then they're getting all the capex. And what they're doing is, let's say the spread is 375 over SOFR. They are buying a 1% cap on SOFR to get a 475 for 3 years.
Okay, and I apologize to everybody. Gardner normally comes early on Thursdays. He's now here. I hope you don't hear him, but it's all
right. You're good. You're good.
It'll be like 10 minutes. So a few things about this. Number one is this is negative leverage from the start, correct?
Well, they're saying going in cap is the in-place cap is 4.13.
Yep.
And the interest rate's 475. So based on that, correct.
Yeah, that's yellow flag number one, I'll call it. If you believe in the full execution of this business plan, you may not care about that as much, but that's yellow flag number one to me.
Okay.
Next question is the capital stack. I'm sorry, because I'm having a little trouble reading some of it, but would you happen to know? Yeah. So would you happen to know what I call the cumulative loan to value, which is not really the cumulative loan to value, if you add in the debt and the preferred equity piece?
So there's no preferred equity. This is just normal. So the total loan.
But there's 10% preferred cash on cash return, no profit participation on the side, on the sale.
Yeah. So I think that's they did not give a number for that, but it's not like it's a third party. So I think you can choose your tranche, but yeah. So
you're saying that it's not actually ahead in the capital stack, but it's just a preferred equity structure.
It's slightly ahead.
Yeah,
it's slightly ahead.
It is slightly ahead.
It is slightly ahead. But they did not give a number on that. But so in total, they're doing 70% of purchase plus 100% of capex. So let's call it, 75% ish loan to cost, in terms of if that's what you're trying to get to.
I'm trying to get to the current purchase price, not the cost, but to the purchase price today, and what the current debt is, plus in terms of percentage of loan to value, current value, plus the Class A stack, essentially.
Okay, I don't know the Class A stack, but the total loan is about 23 million. 23 million, and then the purchase price is 25. So, but that's obviously assuming, so that's 92% leverage, but they're doing a $5 million rehab. So, I can't. So it's about, let's just say this is a 200 unit deal. I can't remember what it was, but that's like 25,000 a unit rehab. Pretty big rehab. Yeah.
So look, the first thing I'll say is that this is being done at challenging time, just like we talked about before in terms of timing.
Sure.
And you have very little room for error, given that you're boarding $23 million on a $25 million current value, which, by the way, may be worth less at the end of the year based on what we discussed, right? So you have a very slim margin of how much true equity you're going to have if anything major goes wrong. If they execute 100% flawlessly, you can make an argument the deal might be okay. But in my opinion, $23 million of debt on a $25 million purchase is pretty high risk. What is the projected IRR?
I don't have it on this one, but let's just assume 15%. I mean, pretty standard 15% IRR.
Yeah, and that's the challenge I have, because are you getting the commensurate return for the risk of this type of loan, or are you getting an end of cycle, risk reward profile? And that's just because it's quite just hitting the margin for investors to attract capital, but doing it at the wrong time with all these headwinds, where investors are getting a much wider band of outcome than they understand they're going into, right? That's what we talked about before. That's what I see in this deal, is a very wide band. And the question is that 15% meriting to have that wide of a band? And my opinion, without any more information, I don't have very much, is probably not. But my biggest problem with this deal is timing. I won't even get into the floating rate loan and everything else. That's a whole different problem. But just with the numbers you're giving me, my biggest problem with this deal is timing. Negative leverage, floating rate, all that stuff is also very challenging.
All right. So we got development, value add. So this is a different deal. But there's different classes that people are sort of allocating into. So you got your class A, which is just cash flow, no profit split. And then class B, you've got just sort of a 7% preferred 70-30. And in class C, you get a little bit more. If you put in 500,000, you do 8% preferred 80-20. What have you done in the past? Have you mostly stuck sort of in class B as sort of like the normal, right? 7% preferred and then 70-30. I think that's pretty standard.
Yeah. And so I have a very strong opinion on this, because big challenge I have with preferred equity. And I've done a few deals of preferred equity, but nothing like what you have in mind. I mean, just the risk reward was just outstanding. It was in a different part of the cycle. It was just, I can give you an example, but I've done a couple, but very unusual ones. The standard ones where I have a huge problem is that you're being offered, what is it in this case? I'm just having some trouble reading it. Sorry.
The class A?
Is the preferred equity?
9%. 9.
Okay. So you're getting 9%, no upside, right?
Yep.
And you're behind the debt. So
correct.
If you were like a second position loan that actually had recourse on the deal to actually take it over, right, legally, you'd probably be in the 10-12% range is what I'm guessing, right?
Okay.
And so you're getting literally paid less than someone who is taking less risk than you in a second position loan. And so the risk reward of preferred equity in the past few years has been very low. But the reason why investors have been attracted to it, like we talked about before, is because the numbers are big enough to attract investors, but I don't think they're taking into account the risk properly, right? The risk reward properly. And so
yeah.
Go ahead.
So I think what's a little bit different is that if somebody comes in and writes, let's say you have a loan at 70% and then you want to put 10% preferred equity, that usually is a pretty big check, right? Let's say it's a $5 million check, just to make up a number. But here, these are just like individual investors. So they're only putting in 50,000 versus that guy who's writing the bigger check. Yeah, he's going to want like 12 or 13 or 14% on the deal compared to an individual investor. They're not necessarily going to want, they're not going to get more than the 9 or 10%.
Right. So you make a very good point. It's not realistic for you to become the second position loan. It's basically what you're saying. And so you're like, is it a fair comparison? But the challenge I have, and you're 100% right. The challenge I have is that this isn't just a returns to return comparison, right? Like, it's important people to understand that when someone is getting that 10 to 14%, whatever numbers we want to make up at the moment in this current market condition, they're not only getting a significantly higher yield for their opinion of the risk premium, but they're also getting recourse to take over the property potentially, right? You are just being wiped out. So to me, I'm not saying people should go do that. I'm just saying I don't think you're getting the commensurate reward for the risk. So there's a difference, right? I'm not saying that's a good alternative for somebody. I'm just saying that if that professional lender is doing it that way, then and they're protecting themselves, at a higher return and with much more recourse, what does that tell you about the position you're being put in, and doesn't make sense in terms of risk reward, or are you taking on more risk than you think?
At some point on the B versus C, would it ever make sense as an individual investor? So I know some people have sort of like done like a fund of funds where they, get 5 guys and they come in as class C and they just get better returns together. But would you, let's say you had 500,000
Mhm.
versus putting in 50, would you ever on one deal go up to class C to have that much sort of exposure to one deal? Does that question make sense?
Yes,
Okay.
100% makes sense. First of all, and everyone does things differently, but I am very big on hyper diversification, so to speak. And I have a lot of reasons for that. So I'm the guy that would be more likely go to the lower amount and not necessarily try to get the higher returns, but taking on much more risk. So it's not my personality. But I think the answer to this question totally depends on not just your risk profile, but how much capital you actually have,
Right.
right? So it's a tough one to answer without knowing the bigger piece of the puzzle. But I do think personally, I'm just very low risk. So I'm in over 60 LLCs actively right now. And I've been in over 150 to 200 over the past 20 plus years. I'm not telling people they should do that. I think it's very hard to do. I do it full time. So it may be overdone, but that's the way that I lean in general as a person. My accountant's complaining about my new
The
LLCs
K1.
from sorry, K1s from 2022 that are brand new on top of the other ones, literally just yesterday. So that
Yeah.
just
So you're saying, all right, I'd rather just do 10 deals in class B versus one deal in class C, essentially.
100%, yes.
Okay.
And there's multiple reasons for it. It's diversification across asset classes, geographies, and operators.
Got it. All right. Perfect. I'm not okay. I'm gonna put this one on there. I don't know. I think we've touched on this one enough. I think I'm gonna skip it. I want to go to this next one. It was similar to the value add deal, but
Uh-huh.
I wanted to go to this one. So this one, essentially, what this pitch is saying is, um, come in on the GP side of the deal.
Hmm.
We are raising the other, let's say 90% of the stack from institutional equity.
Hmm.
And now we've got this 10%, and we normally would put it in, but if you come in on it, we'll share some of the fees with you, essentially.
Hmm.
So I don't necessarily know this operator. And I think this is a little bit the slide that I have on here is a little bit confusing. But essentially, if you look at the bottom, they're saying, all right, so acquisition fees, we're going to give you 10%. The asset management fee will give you 10%. And the promote, we're going to give you 20%. So just use that as sort of, that's going to juice your return from a normal, let's say 2x return and 17% IRR. And that's going to get you to a 3x return and a 25% IRR
Uh-huh.
because of these additional fees. So what's your thoughts on this? Because it's a relatively new thing that I've seen just in the last couple of months.
Oh yeah, no, these have existed for a very long time.
Okay.
So they're very hard to find.
Yeah.
So, but I mean, there's actually GP share funds
Okay.
where
Yep.
literally they'll pool together money just to find these pieces. So I haven't done much of this. I don't think any ever. I will tell you that people do find the risk reward favorable very often with these, but they're hard to find. A couple things, 'cause I'm a cash flow investor, right? So, there's a thousand ways to invest, and none are wrong. But because I'm a cash flow investor, my number one concern in looking at the IRR is how is that derived, right?
Right.
So, in other words, is it really heavily back-ended, just like a heavily back-ended deal is typically for a GP? Because if it is, does that mean that I'm not going to get the same level of cash flow? So you can have a higher IRR in this fund, but end up with less cash flow than the LPs throughout the deal, right? And so that would be one thing I would be looking at very, very carefully to see if it fits my parameters or not, and also to understand the risk you're taking for the IRR bump, right? That's very important. Just looking cash on cash return. All right, they're coming up with an 8.16%, but again, it's average annualized, doesn't really tell you much, right?
Okay. Yeah.
So
This is just a
yeah,
sample fund. Yeah. It
yeah.
doesn't have
So
actual deals.
so let's assume that the return's very back-ended, and let's assume that you're, willing to take a little more risk, and let's assume you absolutely love a sponsor that you invested with before, and you're okay taking that back-end risk, and you want higher returns. This could be a good scenario, just for the right fit of personality. I know some people like these.
So you're thinking that if you're in this fund, these guys are sharing the fees, but because they have to pay a preferred to the limited partners, you might not be eating for a couple years,
Oh
and
yeah,
you might be eating in year 3 versus year 1.
yeah, and frankly, you may not be eating for a long time. Really,
Yeah.
as you know, some deals don't ever go beyond the pref,
Yeah.
and then everything's on the back. And that was my point at the beginning. Is if you think about a GP's business model, they make a little fees up front, and they make a lot of fees at the end, and they often make nothing or very little in between. You'll be in that bus, right? Do you want to be on that bus or not? And is that the road you want to go down? It is the right road for some people, and it's the wrong road for others. So, but there are some of those scenarios that are good.
Okay, so I think on because I think most people are just thinking, all right, I'm an LP, but I'm getting part of the GP
hmm
piece, and so they're thinking, all right, this is no brainer. But you have to you have to dig in a little bit more to figure out, make sure that you're still getting sort of your LP return first, and then this is just like extra juice on top of it.
Right, which I'm going to tell you right now is not normally the case. Normally, in exchange for having, because that's how the GP works, right? If
Yeah.
you're going into the GP stack, you're behind the LPs and getting paid out. You're actually behind the preferred return, right? That's the
Mm.
definition of being the GP. You're behind the preferred return. So if that's how this is structured, which is most likely the case, you have to be okay with that risk as an LP for the additional reward, which is the right thing for some personalities and the wrong thing for others.
Okay. I don't think most people understand that, but we'll keep going. So
I'm sorry.
make sure. So
Yeah.
do you think so? I mean, normally you do this, but like I guess read the operating agreement. Make sure you know where you fall in the stack on this if you go into one of these deals, because it's probably like if you just get a deck and they have some numbers in there that are sample numbers, you probably need to dig in a little bit more, I'm guessing.
Yeah, I mean, don't
Yeah.
go into this type of deal unless you understand it. That is
Right.
100% for sure. But picture yourself being the GP in terms of how the flow of the payout goes. And when you're the GP, you're behind the LP and you're behind the preferred return. You have to make sure you're okay with that and that the reward you're getting is commensurate with the risk.
All right, perfect. Okay, so we're about an hour in. We're gonna wrap up. We're gonna go a little quicker here. All right, this is a fund versus individual deal. I have not done a fund, but a lot of people are doing funds, are setting up funds, and um, what are your thoughts? Have you done funds?
I've done many funds, I've
Okay.
done many individual deals.
Yes.
What I've normally seen throughout a cycle is that funds typically become more prevalent at the end of a cycle because there's a lot of cash floating around, and it's often easier for the sponsor to execute if they're able to just raise a bunch of money and buy a bunch of properties in one fund, right? It's an easier execution structure and vehicle. But what ends up happening is that it's harder to raise money at the beginning of a cycle and a cycle reset. And so often you'll see sponsors revert to going to individual deals because that's pretty much all they can raise for on a property by property basis. And also there are a lot of investors who prefer to invest in individual deals, all things being equal, because they actually get to analyze the individual deals versus going into what may a completely blind pool fund or a semi-blind pool fund, which we could talk about. And by the way, blind pool versus semi-blind pool have different risk levels as well. So I'm actually a bit of a fan of, if you really like a sponsor and you want to get diversified across properties with them, and you're able to wait until most of the properties have been purchased, so getting in towards the end of a fund closing, yes, you might be giving up a little return, but man, you can actually then analyze all those properties. I've done this many times, and then determine if you like the property set, and you're giving up a little return in exchange for making sure it's the right profile for you. That to me is a really nice balance if you're considering a fund, but everyone's different.
So that I'm gonna have to like remind myself mentally to clip that 1 minute, and just that sentence of you saying that funds are typically at the end of a cycle would have probably saved a lot of people last year.
Why is that?
Because the number of funds, like
Oh,
there were a number of funds last year, 2022, beginning of the year, where people were raising huge funds, like 300, $400 million funds. And I was like, yeah, I was getting comfortable.
got it.
But if you would have told me just that one line of usually at the end of a cycle, more people are doing funds versus at the beginning of a cycle, most people are doing individual deals. Because now I think if somebody goes out with a fund and it's blind, I don't see them. I see the ability to raise equity very difficult.
That's right. And that's why you probably won't see very many of them now. That's
Yeah,
exactly
yeah. I'm
right.
not gonna see like the
Yeah.
majority of the deals going out right now are individual deals or maybe one or two deals, and it's like a portfolio, and that's it.
Yep.
So you know exactly what you got, what you're investing in, and
Yeah.
so
But let me just say, I'm not a financial advisor or anything like this, but if you're
yeah,
using the metric of just how many funds are out there today and how big are they to determine where in their cycle, I think you're looking at the wrong thing. Not you personally, but anyone listening to this, right? Because last year there were a God knows how many indicators that we were end of a cycle. We were at a record long cycle. We had stimulus that was only going to last temporarily. We had an inverted yield curve. I mean, I can go on and on and on.
right.
So, yeah, let that not be your only indicator of where we are in the cycle for sure.
No, no, no. It's not that it was the only indicator, but I had never heard that
Oh,
in
okay,
the analysis of um, looking at a fund versus an individual deal.
okay, and
So yeah,
yeah, and I was going to say one of the things I really like about this exact timing that we're talking today is that, like, if I would have told you that 2 years ago, you may or may not believe me. You may have been like, "Ah, is that really true?" But now we can actually look back and see that that's real, right? And it makes sense now. And one of the things I love about talking to people right now, whether it's you or other people, about trying to figure out what's going on, is that you can actually now look in retrospect and see, like, okay, Jeremy's saying that you don't do value add at the end of a cycle. Oh, now I understand why, right? So I was saying the same thing 4 years ago, but maybe you weren't paying as much of attention, or whoever it was, right? I'm not. It's not about me. It's just
yeah.
about, like, just the way things work. But as an investor, there's a lot of really good lessons you can learn now, just in terms of learning how a cycle works and what happens, for the next time, by now looking back the past couple of years, because now everything is played out. It's almost like you're sitting in the sixth inning of game, who's going to win? But now we're actually able to talk in the bar when the game's done, and talk and analyze the whole thing. It's a lot of learnings are going to come from this now, and it's a great time to be thinking about these things.
And it is only the beginning.
It is. It is. Yeah. Unfortunately.
Okay. I thank you for staying on. The this piece is a little different in that this is a deal where they raised common equity, and now they need more money, right? So they did a capital call, and my guess is the capital call to the original investors was, "Nah, we're not putting in more money in this deal." So now they're going to a new group of investors saying, "Will you guys put in money into this deal because we need help, right?
Hmm.
And we'll give you a preferred placement in the stack. We're going to give you 8% current, 4% accrued, so 12%, right? And then once we refinance this deal, you'll get all your money back."
Okay. So one of the most important questions is, what is the current status of this property and what is it currently worth today? Those two things, like, what is the business plan? How far are they along into it? What is the current, broker's opinion of what it's worth today? Like, what are you getting yourself into here,
Mhm.
right? Because if you're adding, if you're I always like using extreme examples to make a point. If somebody says to me, lend me $1 on the Empire State Building, I'm like, sure. Like we have, but take a look at the rest of the capital. If there's 150% loan to value, no, right? So you have to actually take a look at the whole scenario. And I feel like we're missing a very important piece of the picture here.
Okay, so they're saying the property, here's the valuation in the middle, 37.6 million. They're saying that is the projected, I guess you got to underwrite it, but
no, that's a projection. I want to know the
current valuation. What is the lender think it's worth? What does the appraiser think it's worth?
Okay. I mean, are they asking you for money when let's use an easy example. Total budgets. So what is the capital stack right now? Right now that's in it.
21 million, senior debt.
20, 32, right?
Yep.
32. So total budget number. If you find out that a broker's opinion is that the building's worth 28 million right now,
right,
are you going to lend? Well, then it depends on what's the business plan and where is this going? Do you want to make a bet on people? And also, I want to point something very important out. The preferred equity terms, 8% current, 4% accrued. Are these people going to be able to pay you 8% current? Current cash flow, is that coming out of this deal? And yet they're desperate to get money into the deal? Something's not adding up, and I think that preferred equity is going to accrue at 12% or at 10%, meaning you're not going to get 8%, you're going to get like 2%, right? I don't see, I don't have enough information to know that for sure, but that's one of my suspicions right now.
Well, let me say, that's why I only show you one part of the deal, but your questions are good enough. And I think you know the answer to these questions. So let me see if I got another one. All right. I threw this one in there just for fun. Office deal, 9% cap rate in Atlanta.
Okay. Anchored by global tenants, institutional sub. So it doesn't tell you who the tenants are. So, okay. Office right now. So I think that people know from the mass media coverage that office is in a very tricky space right now. People are expecting a ton of office foreclosures. But different office is in different risk. So let me just give you some really high level, blanket statements that won't apply to an individual property. Office in urban areas like, downtown New York, San Francisco, etc. Very high vacancy. Each city is different. Very high vacancy rates, very high probability of some foreclosures, very high probability that there's way too much oversupply in a market that may not be demanded anytime soon. One risk profile. Suburban office, where there may be a lack of supply in a certain suburb, maybe this deal, considering how leased up it is, right? But if you've ever invested in office before, you know that you have varying lease terms. You can have 1 year, 3 year, 5 year, 10 year, and all different types of escalation clauses, etc. You can also have certain leases that actually include common area maintenance, non-common area, all kinds of stuff. And so triple net, not triple net. Long story short is that one of the first things I would do is determine the location. And I would also determine the rent roll and see who is in there and what the remaining lease terms are on those current leases, and also who the tenants are. So I'll give you an example. James, if you said to me, I don't know the biggest hospital, you said this in Atlanta, correct?
Yeah.
Okay. I don't know the biggest hospital system in Atlanta, but if you said this is, 98% leased, anchored by the largest hospital tenant who has a 20-year lease remaining, they have a millions of dollars in TIs, they have some equipment that would be very hard for them to relocate. There might even be X-ray scanners, whatever it is that you're walking into this building, high probability they're going to stay. That's one scenario.
Right.
If you say to me, there's I couldn't even tell you what it is, tech company that, where there's just coders who could be living anywhere, and you run some of the turnstile scans and you get some of that data, you find out that 50% of the people are coming in each day. And by the way, one term is 2 years, one term is 3 years. This is a very slow moving train wreck office because there's lease obligations, and short of people breaking all their obligations, they're contractually obliged to pay these. But then when they're done, they're either going to take half the space they took or none of the space they took potentially. There's a lot to kind of unpack from this to really understand. It could be a really good office deal and it could be a horrible office deal and anything in between. But just know that office is a headwind at the moment, right? And by the way, we haven't even gotten the recession yet with companies going bankrupt, etc. And so office hasn't seen its true carnage yet and is at very high risk, not just cyclically in its own use life cycle, like useful life cycle, but also within the actual economy. And so you should expect rents to go down, even if this is a very, in the area you're in, even if this building is very high in demand. And if you have to replace a tenant, you need to also pro forma that, even in the best of scenarios, right? So so office question mark, answer is headwinds, right? So sorry,
Yeah.
there's a lot to unpack, obviously.
No, the biggest deal that we did at G Capital in Dallas was an office portfolio, and we got our butt handed to us. I mean, we probably gave a $500 million loan, and we probably got out at 250. Like,
Okay,
we just
but
got
what's
clobbered.
what's the lesson though? Like, what happened exactly?
We thought that, so a lot of it was single tenant office,
Hmm.
80s product, suburban. And we thought, you cross them all together, and the thought was not all of them will go down at the same time. But then
Okay.
we made a loan in 2006 or 2007, and then the recession hit, CompUSA goes out. Every tenant was going out left and right or giving back half the space.
Mm,
Like the exact same thing that's happening right now in terms of, like, First Republic got eaten up by JP Morgan. All their offices gone. They don't need any of it. Right. So that uh, consolidation of space. I mean, like, you probably don't listen to this podcast, but there's a loan data provider called Trep, and they do a podcast. Literally, it's 30 minutes of talking about sublease space every week. Like, people just giving up
wow.
space every week, and it's impacting all these office buildings that are backed by CMBS loans. And the special servicing ticker for office, it's still low right now, but it's gonna go to the sky on
Yeah.
special servicing. Yeah.
So, one thing we didn't even touch upon is that if this is the right building to invest in, but you get a couple people leaving just because you end up at like 85% occupied instead of 98 currently, just because of the economy, right? You get an economic
Yeah.
downturn. The one thing that is killer from a cash flow perspective for investors is that they're often, if your turnover isn't like nearly high enough in your projections, then you will have a ton of TIs, tenant improvements that were not forecasted. That's all going to come from your cash flow, if not a capital call. And you will end up with significantly lower cash flow for the whole deal, if not some of the deal, depending on exactly what's happening. So
So the
that's
only
another
yeah.
challenge.
So the only guys that made money in office that I saw were essentially when we foreclosed. So we, the lender, foreclosed on the office building. We would literally give the office building to somebody vacant, essentially for free.
Yeah.
Like, we said, all right, here's a building that we foreclosed on. We gave them a loan for $20 million. We'll give it to you for 15, and we'll give you a loan for 10 or 12. Like, you chip in $3 million, you can have this 300,000 square foot office building. It's vacant, right? And they would say, sure, we'll take it. And we gave them the money for the TIs. We gave them the money for the leasing commissions in the loan. And then they would lease it to one guy or two guys or three guys. And, over a couple years, they get it to 85, 90% occupied. Then they would sell it for $40 million, pay us back the loan, and make a gazillion dollars.
Do you know what the problem with that right now is, though? Because
Okay.
that sounds great. Do you know what the
Yeah.
problem right now is with that? Is that the structural demand has changed, right? The long-term demand has changed for office space. So you can't be the guy that's just going to have all that runway that you're giving them to actually fill this thing up, because it's not going to fill up. And
Mm.
so if you have to pivot and actually take this building and repurpose it, forget about demolishing, just repurposing it, right? It does not conform to residential like a lot of people think,
Right.
It does not conform. There is not the plumbing you need. There is not there are so many things that are off that the cost that it takes to actually get it to become residential, often you cannot even pencil out if you give it away for free.
Mm.
Like that's what's going on right now. A lot of people are looking at these deals and trying to figure out what to do with them. There are some things that could work. Sometimes storage could work. Some other things are easier than others. But right now, the problem is that you can't be the person that gets a building for free because you're not going to be able to lease it up in its current state. It's just not realistic to do that anymore. That was doable in the last cycle, but not now.
I think it was in LA or somewhere in California. They just scraped it. They just scraped the
Yeah,
building
yeah,
and
and
started fresh and got
yeah,
it rezoned, right?
yeah, and that's but that's a whole different level of risk, right? Because now you're doing literally a development from scratch. You're not taking the building, stealing it, and then releasing it over time, or even repurposing it, which is less risk to an extent than doing a full-on development.
Right, 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 right. Okay. All right. So, all right. So that was all the deals. That's all I could handle. But the like us doing this conversation right now, I almost have to have you come to the conference, and I feel like this is going to be a session because Brian Bell is asking where can we follow Jeremy? Dude is a shark. So thank you, Brian. Jeremy, maybe we'll put your email in the chat here and let people follow you for more stuff. But all right, so let me wrap up here. All right, so okay, so here's my question. So you've talked to a lot of GPs, you've seen a lot of GPs. If you were to teach a course on how to be the best GP, give me the outline of what would be in that course.
Well, I mean, I'll tell you right, I'm not qualified to give that course because
But you talk to enough GPs.
but I've
I'm
never
just
been
saying
a GP.
outline wise.
Okay. All right.
Outline
Fair
wise.
enough. I just
Okay.
never been a GP. I
Yeah.
don't I don't want to pretend like I actually have a good answer for people when I'm not really qualified. But
Okay.
because James is forcing me, um, I would say how to be the best GP. Geez, there are certain sections I could probably really well contribute to. Investor relations, how to communicate with investors, reporting, all that type of thing. Structuring for investors, even some of the legal terms. I've looked at so many operating agreements at PPMs over the years. I've even consulted with some companies on them. What I cannot do is tell someone how to operate a building on the ground. Like, I have no knowledge of this, no experience in this. So I would say so those components I just mentioned would be part of the course because that's an answer to your question, right? All those pieces,
Yep.
and they're all important in many different ways. But the funny thing is that if you take all that stuff out that I am a little familiar with, the most important thing is running the building. I always tell people I'd rather have, like, if you look at the outcome of a deal as an investor, right? I'd rather have a sponsor with the worst documents and the least fancy presentation, but the best execution than the fanciest, best documents and the worst execution, right? And I've been saying that for like over 20 years, and it's still true. It's actually a lesson that I learned very early on when starting to compare people and deals and stuff that I tried. So I think that's really important. And so, it's so anyway, long story short is that the execution is really key, and I couldn't contribute to any of those thoughts.
Okay, so maybe let me rephrase this question. I should have thought about this question a little bit more. But
Sure.
how, like, the best GPs that you work with, how did they become that good?
Okay. So I think it's a number of key things. The number one thing is, who is that individual? Are they really detailed? Are they conservative or aggressive? Are they really caring about the investor outcome? Are they trying to raise as much money as possible? These are some of the things that I try to piece together when I'm trying to decide who would make a bet on. Okay. And some of those people, I think, have been some of those successful who checked all those boxes. But I want to say it's absolutely imperative not to grow too quickly. And I think, unfortunately, like, I had a call earlier today. I was made aware of a sponsor who had just grew really, really quickly in the last 3-4 years. Really nice guy. Clearly, I won't name him. I know him. I did not invest with him, but I know him. And he just grew too quickly. And now he's like having all kinds of challenges with his deals because of the growth alone. Right. And so some of the best GPs are in this in the really long game. They're not trying to maximize their short-term revenues. They're trying to do the right thing for investors, grow a business with the correct strategy and method and business plan, and look at it very, very long term. You want someone who's thinking 20, 30 years are going to be in this, and they're not going to grow it too quickly. And therefore, they're not going to get over their skis. They're going to be able to build their in-house property management if they have it correctly over time. But in the end of the day, you need a great entrepreneur to be able to do that, right? And, I'll tell you, James, this is not at all relevant to what you're asking, but at least it's not a direct answer. But I have like 1% of my portfolio in startup investing and 99% of low risk, more predictable cash flow. Okay.
Yeah.
And I'm not looking for startups, but sometimes I just have to make a bet on somebody. Like someone I know well, I'm like, the possibility comes up. They show me something. I almost feel like I have to make a bet on them or I'd be really stupid. And I kind of like the business plan well enough and I agree with it. And I think there's like risk reward there. Right. And I do it. And when I was much younger and I was more into startups just because they're interesting, and they have big return possibilities, I want to get to know the people as well. I get random pitches, invest in them, and a lot of them went to zero. Not all of them, most of them went to zero, like you would expect. As soon as I changed that 1A and said, I am not looking at any more random deals from anybody ever again. But if the right thing comes along, I just have to make a bet on them. Okay, you got to do it. And that success rate has been, at the moment, practically 100% with ridiculous outcomes. Okay. And I think the only difference was, who am I making a bet on? This is where I have a big issue with VC funds, where they're having to throw money across so many different pieces, up on the wall so many times. They can't possibly know all those people as well as I know the random few people I make a bet on. Right. And so I think my odds are much higher. And if you get to know this GP, this person, to the point where you're like, I got to make a bet on that person, that's the entrepreneur I have to make a bet on. That's how you become one of the best GPs. You have to be that person, right? So you have to have a certain set of skills, a personality, etc. And that's it. That's a bit intangible. So it's not a great answer for that, but I think it's very comparable and very important.
I'm trying to figure out. So that's what I love is I throw questions at you, and your answer is usually better than the question. So that's perfect. So this is all right. I'm gonna skip that one and I'll come back to it. But this is the actual question that I wanted to ask you, but then I added a GP one. So if you're going to teach the same course, a different course, but for LPs. So this is the question that came to mind first, but then I added the GP one just for fun. So what are your thoughts here? Outline.
Oh boy, there'd be a lot in the course. So there would be.
Let's go 5 things. 5 things.
Yeah. So clearly how to review a spreadsheet and underwrite a deal or see if you agree with the assumptions, right? So understanding a spreadsheet, revenues, expenses, inflation assumptions, exit assumptions, capital stack, all the stuff you'd see in a typical projection or pro forma, an Excel spreadsheet. That's number 1. Number 2 is some key things to look at when determining if that sponsor is the right fit for you personality-wise, which we just touched upon a little bit. But I tell people that I'm a very conservative person, and the sponsor I'm going to align with the best is someone who's also conservative, right? Who's trying to underpromise and overdeliver for investors to build long-term relations with investors. And I'm trying to avoid the aggressive people who are actually just using those fancy marketing materials. And whether or not they perform well for me, they're just going to move on to the next investors because they're great marketing. And that's what I've always tried to stay away from. But it's also not just being smart, but a personality fit, right, for me. So that's kind of bucket number 2. Bucket number 3 is understanding cycles and being able to look at macro. I mean, this is going to sound extreme, and I actually think it's extreme, but I used to tell people I read 2 to 3 hours a day, but now it's up to like 4 or 5 hours a day. And I'm almost reading too much. I never watch TV anymore. Not a great balance, but I'm doing it because of what's going on in the economy today. It's a very, very important time. It's not just like, oh, we're at the second year of a cycle, but I cannot stress enough having your own opinion about where we are in this economic cycle as it relates to how it can impact real estate. Because like we discussed a lot of times on this, just because the only deals out there were floating rate, and I'm sorry, I don't mean to pick on them. I'm just we can now look back and learn. Just because the only deals you were receiving in the last 2 or 3 years were floating rate apartment deals, it didn't mean that if you did an analysis on the economic cycle, you would agree with it, right? But if you didn't do the analysis and just said, oh, I want to invest in multifamily, here's the 10 deals I can look at today, you're going to pick the best one you can find in the stack. That's a natural, normal thing to do. The problem with that is that you didn't take a step back and determine if it was the right time to invest, period, right? And I find a lot of investors, unfortunately, don't do that. And I think it's really critical. That's how you avoid the landmines. This is actually why I'm not going to get hit by a floating rate loan, because I didn't invest in one because I had an opinion about the cycle. And you don't have to be a genius to have an opinion about the cycle. You just have to realize it's an important piece of it, right? So that's an important thing. I would definitely discuss a little bit of background checks. I feel like people hardly ever do them, and it's a mandatory thing for me, for sure. I would give some examples of why I think meeting someone in person at least once before you invest with them, which I know is very difficult for a lot of people to do, definitely reduces your risk of who you're making a bet on. And it has to do somewhat with what we talked about before. That's the most important aspect. Who you're making a bet on is even more important than the property, not by a ton. It's definitely, property is a huge importance factor, but who you're making a bet on is absolutely the most important thing. And in order to assess that, in my opinion, you got to have a gut feel. In order to get a gut feel, meeting with a person in person, I mean, like this is the next best thing, right? And this is becoming something you could do more easily. But I we don't have time. I have all kinds of stories about how I saw things and, what one trip looks like when someone's touring you a property versus another, right? Those are we could talk about that another time, but you learn so much about somebody during these on-site visits and in-person meetings. I mean, there's a whole bunch of other stuff we talk. Of course, markets. What asset class is the best fit for you? What are the best asset classes for predictable cash flow for the next 10 years? Let's talk about that even, right? There are so many things that could go into this, but this is assuming you're looking for more predictable cash flow, which is what I focus on because that's what I know. So it'd be that type of a course.
All right, that's gold. I got one more question, and you have done great. I prepared you, not at all. And I know this is how you love it. So if someone, a general partner did come to you and they were like, hey, Jeremy, we need more money for this deal.
Yeah.
And it could be for any reason. Why would you invest in that capital call? Like what would be the requirements?
Yeah. So the first thing I'll say is the really easy answer is I don't mind investing in a capital call that is actually improving the value of the building. And that happens a lot. That can happen in an office deal when they're about to move one person out and they're bringing a whole new hospital tenant in. That's great for the next 20 years. But hey, we got to put $1 million up front. It can't all come from the cash flow. Put a little money up. And now that money is actually going to be worth more because you're increasing the value of the property. Great reason to do a capital call. I've been in those scenarios before. Assuming you have the capital, could be a really good risk reward scenario, right? Bad reason to do a capital call is when you're in a deal that's a sinking ship and you run all the numbers yourself and you're like, what is the probability of this actually working out? 5%, 10%, 15%? Now you get into a scenario where that money is not only not going to increase in value, well, literally could go to zero, right? And so I'm not telling people not to invest in capital calls, but I am saying if you're going to look at something in a scenario where it's not going towards the improvement of a value of a property or of improvement of a cash flow stream, then you really need to do a ton of analysis to understand, am I better off, assuming it's equity and not debt, right? Am I better off getting diluted a little bit, but not throwing bad money after good? Or am I better off, actually putting some money in because I think the probability is high enough that money is going to come back to me somehow, hopefully with a return?
Yeah, it's definitely tricky. Would you need to be in let's say you invested in a common equity part of the stack, and then now they're saying, all right, would you need to be in front of the common equity? Or are you okay being just, I don't know what the right word is, just maintaining your ownership?
So you're saying, am I okay with doing equity versus debt? Is that what you mean?
Just so it's still equity, but then they would pay back this new money first before the old money.
They create like a preferred equity type.
Yeah, just for the new money.
Yeah. So I'm actually totally okay being in a common equity if that's what it is across the board for everybody. If you
Okay.
said to me, you're in that office building, they're about to bring in one of the big, anyone you want to pick, big hospital systems, John Hopkins for the next
Yeah.
20 years, and they're not going anywhere, and everybody's putting in common equity, and you run the numbers 100%. I've been in those scenarios before, 100%, no problem. And in fact, to be honest, in those cases, it might be better to do common equity because you're getting some of the upside. Whereas with
You're getting
preferred
upside.
equity,
Sure, sure.
yeah. So you have to look at each scenario differently.
Okay. Because the way I was thinking about it was, let's say someone bought a deal 2 years ago, and now, essentially their basis, their value has gone down 20%. And you're investing into that new deal at that basis, essentially.
Okay. You're talking about the common equity or the preferred equity?
Common.
And by the way, I'm sorry because I was answering all these questions as if I was already invested in a deal and now there's
Yes,
a
I
capital
am.
call.
Yes,
Okay.
yes. You
Yeah.
already invested. So you invested in a deal. Let's say you invested in a deal in 21,
Hmm.
and um, you put in 100,000, and now they're
Hmm.
coming back to you and say, "Hey, we need an extra 20,000."
Hmm.
And if you don't do it, you get diluted. But if you do it, you maintain your ownership percentage. But would I rather spend that 20,000 on that deal, or would I rather put that 20,000 in a new deal at a
Yes.
reset basis?
100%. So that is where the risk reward comes in. You have to figure out what you think you're going to earn off of that, right? Because it just to your point, and this is very important to consider when you're doing a capital call. This is like you're now making another investment in something, whether
Right.
it's that property or something. Like you can use that money for whatever you want. You can buy a car, you can make an investment, right? So it has to be looked at completely separately. Is that a good use of that capital? And that's why I was saying you really got to run some numbers and determine what is your ROI going to be on that capital, right? And there are some really favorable capital calls that I've been in before, and then you could be in others that are just it's a sinking ship. And so yeah, and that's why I'm saying there are many times where actually making the capital call may make no sense whatsoever. You just get diluted,
Right.
right?
Right.
Now, it's a different scenario when they try to do a capital call, it's a sinking ship and they get 5% response and now the whole property is going to go to the bank. That's also a different scenario. You either put up the money or you take an entire loss. Different, but these are all equations. You have to run the equations.
So you have done phenomenal. I couldn't have asked for a better job here. Every time you come on, I have like 3 pages of notes here in front of me, and so I'm gonna probably have to rewatch this. Very rarely do I rewatch interviews, but I'll probably have to rewatch this to make sure I caught everything. Is there anything else that we did not touch on that you think is relevant for people out there right now?
No, I just want to, first of all, I want to thank anybody who's still on here. I know it's been a long one. Want to thank you for having me on. And I just cannot stress enough, like, please listen to me. The facts are we are starting a credit crunch. It's currently May 2023. We have this recorded. We are starting a credit crunch. The data shows that. Could that change? Yes. Is it likely? No. It's probably going to get much worse, right? Look at the data. There is likely a recession coming up from a probability perspective. That's going to mean increased unemployment. It's going to mean job losses. It's going to mean high probability of rents coming down across most or all asset classes, right? Please keep all of this in mind right now when you're investing because just think about it like we're in 2008. Do you want to go into a deal today or not? And some of them make sense and some of them don't, but just know it's 2008. And I don't mean that like it's exactly the same. I'm just talking cycle timing. Okay. And what's interesting is that if you just waited until 2009 or 10, you were in a different position to allocate that capital. So just know where we are in the timing. And as long as you take that into account, you can make a good decision. But, you know, look at the data and formulate your own opinion. Don't necessarily, is it a hard landing? Is it a soft landing? There's a lot of reason why there's been a lot of soft landing comments because that actually psychologically can change consumer spending and it can actually prevent a hard landing by the Fed planting all this. But do you think it's going to be a hard? The only way you can have an opinion is by looking at the data, not by reading what they're telling you in some story. So please make sure you're formulating your own opinion right now. It's critical if you're going to make investments in 2023.
All right. We will kill it right there. Thank you. Where can we we'll get back to Brian's comment. Where can we follow you? What's the best way for people to reach you, Jeremy?
Yeah.
If they have any questions
Yeah.
out there.
Yeah, so unfortunately, you can't really follow. I literally am on no social media. I have maybe made 2 posts on LinkedIn in my life, and I don't have a website or anything. But everyone's welcome to reach out to me for sure by email. Happy to have a call with people if I can help in any way. Happy to network with people, whatever it is. So best way to reach me is through my email, which is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com. I've also been lucky enough to be in a lot of podcasts. If you search my name and the word podcast and maybe look at some recent ones, that might also be helpful. It's not really following me, but you might get some more information out of it depending on the topic.
Well, thank you, Jeremy, for coming on the show, and you did phenomenal. And if there's anything that you need from me, feel free to reach out. But thank you once again for coming on, and we'll sign off here.
Absolutely. Thanks for everyone for staying on. Hopefully it was helpful for everybody who stayed on here.
All right. See you, Jeremy.